Hey guys, I'm Ashfaq here, founder of A&A Capital. Welcome to our Sunday market breakdown. We typically post this every Sunday on our YouTube channel to give you a heads up on the interesting pairs heading into the new week. So just before I get started, what I do is I'd like to go over our website, as I do at the start of every video, introducing every new person to this channel. So if you want to head over to our website, you can check it out and look at the services that we offer. If you're interested in the high probability setups that we trade with high accuracy and really high risk to reward, you can look at our services that we offer. So we also offer one-to-one mentorship, Forex course, and then all our clients get access to this trades journal as a complimentary where we record explanations, chart visual improvements and returns of every trade. So our clients like to study this to be able to trade independently and trade just like us. If you want to contact us, you can contact us through WhatsApp, and so yeah, my number and then partner's number, and then you can contact us through our company form or on Instagram or email if you wish. So yeah, if you want to look at the detailed information of the services that we offer, just head over to the detailed information, then have a read. You can purchase our Forex course over here. And yeah, read our reviews if you want to get started. Yeah, you can also fill up our get started form. Or if you want to join our public channel, head over to our link over here, and then you can click that, and then it'll give you access to our public channel. Right, so let's head over to our weekly market breakdown. So the top two pairs that I am going to analyze this week is gold and US dollar CAD. Okay, so let's get started and start off with gold. Right, so gold was also one of my top setups heading into last week, and I posted an analysis on it in the breakdown last week that we posted on our YouTube channel, so you can head that out, where we caught it was around 400 pips heading up here, and then we caught this drop to the pip, and we caught that around 250 pips. So yeah, our take profit was right before that drop, and then our sell limit got triggered, and then that would have collapsed. That would have gotten us another 200 pips. However, we didn't trade last week, but I know some of the guys in our discussion group took this trade and profited heavily off it. So yeah, this is another, gold is also one of my top setups heading into this week as well. So what we can see here is we've been bullish for a long time. Okay. Then what did we see? We saw our fifth wave get completed. So within our fifth wave, we saw wave 1, wave 2, wave 3, wave 4, and wave 5. How do I know that these are the waves? Because I can see the subwaves as well. So I know wave 1, wave 3, and wave 5 will be motive waves, so they consist of 5 subwaves. So wave 1, wave 2, wave 3, wave 4, and wave 5 within my third wave. Then wave 1, wave 2, wave 3, wave 4, and wave 5 within my larger fifth wave of my larger fifth wave. Okay, so yeah, there are 3 rules that you need to know about Elliott wave theory. All are explained in our course as well as institutional trading, but the 3 rules are wave 1 can never exceed wave 2. No, sorry, wave 2 can never exceed wave 1. Wave 3 can never be the shortest wave, and wave 4 can never come into contact with wave 1. So as you can see here, for example, wave 1, wave 2. This is wave 3, so it's larger than wave 1, so we automatically know that wave 3 is never going to be the shortest wave. We know wave 2 never exceeded the origin of wave 1, which was over here where wave 4 ended. And we also know that wave 4 never came into contact with wave 1. Okay, so that satisfies the criteria. Then what we can see here is we've been bearish. We saw this impulse, which I considered an ABC correction, and then we saw that was our larger A wave. Then we saw this contracting triangle that connected our A and B wave, and then we saw an impulse down, so a motive wave forming in wave C. So yeah, what did there's two rules for correction waves. Okay, so A wave can either be a 3-wave structure or a 5-wave structure. Wave B can either be a triangle wave or a 3-wave structure, and then wave C can be a 5-wave. Wave C can only be a 5-wave structure. So what did we see? Once we completed our triangle, how did I know we completed a triangle? Because a triangle, each wave of the triangle is a 3-wave structure. So we had a wave 1, 2, 3, and all these 3 waves will consist of 3 subwaves within them. So we had wave 1, wave 2, wave 3, wave 1, wave 2, wave 3, and then wave 1, wave 2, wave 3. Okay, so I knew that my wave was completed. So then what did we see? We saw this bearish impulse, right? So wave 1, wave 2, wave 3, wave 4, wave 5. Okay, and then we saw this larger correction. Okay, how do I know that wave C was not completed here? Because I did not see a massive impulse. I saw it being very sideways, so I know this is a larger correction. I know this is not an impulse heading towards a new high. Okay, so yeah, so what do we see? We saw this wave 1, wave 2, wave 3, wave 4, wave 5. That formed my larger impulse wave, so wave 1 of my larger impulse wave. Then what did we see? We saw this correction. Okay, this was a very complicated correction, but yeah, it took some time to figure out. So we saw this A, B, C. C wave is always a 5-wave structure, and in this case we had an expanding wedge. And then we saw this A, B, next comes our B wave, and then our C wave was completed here. Then came our double combo. So initially what we could have thought, what we originally thought was, we thought this was our impulse wave to complete our third wave. So once we finished our first wave, our second wave, we would have thought that this was our impulse to complete our third wave. However, we know it wasn't because it exceeded the origin of the impulse. So what did we see? We saw it form as a double combo. Okay, so what does a double combo mean? It's just two corrective waves linked together. So we know ABC is a corrective wave, so a double combo will link our corrective waves. So we saw ABC get linked with another A, B, C. Okay, C wave will always be a 5-wave structure, so wave 1, wave 2, wave 3, wave 4, wave 5, and then W, X, so we know our X is completed, so now we know this is our wave Y. Okay, our wave Y is the final of our double combo. So once we complete wave Y, we should be good to go bearish. Now, with Joe Biden winning the election, fundamentals do not suggest to go bearish on gold. However, we know from back testing that news has very little effect on institutional trading. So as long as your institutional trading is spot on, then you should be okay with dealing with news. So we are still bearish on gold, even though Joe Biden won, and that creates a sort of uncertainty, especially with his tax policies and a new president. We don't know how it's going to go, so obviously there's going to be a demand for a safe haven. But with regards to institutional trading and Elliott wave theory, it suggests bearish. So we should have now completed our wave 2. So now we should be good to go bearish. How do I know we completed wave 2? Well, if we head down to the 1 hour time frame, what do we see? We see an A wave structure, a B wave structure forming, so a 3 wave within the B wave, and then we see C wave being completed. So we see a wave 1, wave 2, wave 3, wave 4, wave 5, right? We see all this being completed. So as a result, I know that my second wave has now been completed. So now my original motive wave should start. Then we saw this massive bearish candle. Okay, that is a very good sign of institutions entering the markets. So what did we see? Originally we had a thought of selling here, however we saw that there were still equal highs over here, so we saw liquidity being rested. So what was this? We saw retail traders move, and then institutions stopped them out. Luckily we saw this in time and we didn't take that. So yeah, retail traders sell, institutions grab price all the way up, stop the retail sellers out, trigger their buy stops, and then stop those buy stops out as well. So we saw liquidity, we saw an order block, so we saw this massive bearish candle. Okay, then what did we do? we go down to the 15-minute time frame, and then we see this classic textbook break-in market structure. So we saw these equal highs get taken out, okay, and then we see this break-in market structure. We get a return to origin. We get a return to origin to trigger the unfilled orders, which is what we're doing right now, grabbing all this liquidity on top. We're triggering these unfilled orders, and then we should be good to go bearish. So yeah, we are going to look this trade we are going to look to take this trade quite soon. Although I sent this analysis into the discussion group to sell at 1957, which is what 1957.682. So yeah, that trade should still be active. But yeah, there's a good opportunity to scale in right now. So what we would do is, all the guys in our Forex course and our channel know exactly what we're doing right now. We go down to the 1 minute time frame. We see our entry criteria. Okay. We see our entry criteria getting filled. So when we see our entry criteria getting filled, we set up our limit order, that gets triggered, or we take it into market execution, and then we take the trade at a max for gold around 30 pip SL. But for normal currency pairs, we typically have a max of around 10 to 15 pips SL. So that gives us a really, really, really nice risk to reward. But yeah, I am seeing these equal highs over here, so we might take this out. So if we get stopped at entry, I'm just going to keep it at entry. I'm not going to remove my SL. So yeah, if we get stopped at entry, then so be it, because we do see these equal highs. So we might take that out on the 1 hour and then go down. But yeah, I guess we shall see. So yeah, guys, that's our my analysis for gold. Yeah, also another thing that I spotted was these buy side liquidity resting here. I didn't consider this as a high, but now, because it's formed in quite a nice range, yeah, so that just got to stop tagged out at entry. So we will look to re-enter if we do see confirmation on the 1 minute time frame to go bearish. And then yeah, so I think that might be equal highs. I'm thinking that could be equal highs, so we do take that out. If we do take that out, this is where we'd enter another bearish order block, and then we'd go bearish once again. Okay, so yeah, that's our analysis for gold. Quite bearish with a really nice risk to reward. So if, yeah, we just got stopped at entry, so if our 1 minute criteria gets filled, we take that. Or if we decide to go for liquidity, we would be looking at this order block right here to take our sell, and we would look to catch out these equal lows where liquidity is resting. So price is always attracted to liquidity. If price does want to make a new lower, new all-time high, then what we would do is first we would take this liquidity and then push higher. So yeah, we are, and then we also have an imbalance here. So institutions had an imbalance, which we like to consider either a liquidity void or a fair value gap, depends on you. So yeah, we'd look to fill this imbalance. We have liquidity resting here, liquidity resting here, liquidity resting here at these equal lows. So yeah, we should take this if we decide to push higher first. So yeah, I hope this helps. That's my gold analysis. Now we'll move on to my US dollar, Canadian dollar, which is another top pair. So yeah, this is one of my top setups heading into, if not the top setup heading into this week, with a really nice risk to reward of 39. Although, yeah, it's a 10 pip SL, suits our criteria, so we should be good to go. But because it's a US dollar pair, I will once again head to the 1 minute time frame and try and get my SL down to around 5 to 8 pips. So that should bring our risk to reward well above 50. Okay, so let's get into the analysis. What do we see? We see, right? We see price has been bullish for quite a while. So we saw wave 1, wave 2, then the subwaves of wave 1, wave 2, wave 3, wave 4. Wave 4 never came into contact with wave 1, although it got very close, but it didn't get into contact with it. So it still satisfies our criteria. Then what happened was we saw this impulse up. So that completed our wave 5. Then we saw wave 4 come down. And then we saw this wave 5 as an expanding wedge. So wave 5 is always going to be a 5-wave structure. So it's a wave 1, wave 2, wave 3, wave 4, wave 5. Okay, then we saw this massive impulse down. That created an imbalance that eventually got filled. So what are we now? We then formed an ABC wave structure because after an impulse wave always comes a correction wave. This is the beauty of Elliott wave theory. You exactly know what's going to come next. So with institutional trading, your success rate is just going to shoot. Okay, so what did we do? We had this liquidity. We took this liquidity out with this wick, pushed price higher, and then came lower. So we saw all this bearish pressure. Okay, we saw all this bearish pressure. That bearish pressure, I presume, was because the stock market did massively well. So what institutions do is they have a whole board of investments. So if one, let's say NAS did really well. Okay, that means they have an excess of US dollar. So what institutions would be doing, because they like to balance everything across the board, they like to sell their US dollars, which pushes the dollar bearish. Okay, now while expecting a NAS crash soon because of Joe Biden, we would be looking to take this dollar bullish, because what institutions would like to be doing is, if the NAS is bearish, they're losing money. So as a result, because they want to balance everything across the board, they're going to be buying the US dollar. Okay, so we saw this ABC wave structure forming. C wave always consists of 5-wave structure. So we saw this wave 1, wave 2, wave 3, wave 4, and wave 5. Then we saw A, B. Yes, we've completed the A wave. Then we saw our A, B, C wave formed for our B wave, because a B wave is always going to be a 3-wave structure. Then what happened was we saw this impulse down once again. So we saw wave 1, wave 2, wave 3, wave 4, and wave 5. Okay, that wave 5 should be completed here at this bullish order block, where we have unfilled orders of institutions resting. How do we know that? Because there was low price action and then price shot up. When price shoots up, there's always going to be unfilled orders of institutions waiting there. That's called the bullish order block. More of that is explained in our course. So what did we do? So so we formed our A wave, our massive B wave, and then our massive C wave. Now we're completing it because the C wave is always going to be a 5-wave structure. So we saw wave 1, wave 2, wave 3, wave 4, wave 5. Wave 3 should always consist of 5 subwaves, which it does. Wave 1, wave 2, wave 3, wave 4. Wave 1, wave 2, wave 3, wave 4, wave 5. That is not considered a wave because it's a subwave within the third wave. So then what did we see? We saw A, B, C get completed to form our 4th wave. Our 4th wave did come into contact with wave 1. However, this does not validate Elliott wave theory, because our C wave can be an expanding wedge, meaning wave 4 can come into contact with wave 1. But our 3rd wave still has to be not the shortest wave. So then, what did we create? This is very common. What institutions like to do is they like to engineer liquidity before they take it out at their order block and then shoot. So right before this order block, what do retail traders do? Retail traders like to get in at a double bottom. That's your traditional pattern that they look for, price action pattern. So that's what they did. Engineered liquidity, engineered retail traders. This move up was by retail traders. Okay, then what did I say here? They're also going to catch out some retail traders here. Retail traders will be selling at this trend line. They're going to encourage, thinking it's a breakout, trigger this order block at the 0.5 fib, the unfilled orders, and then we're going to shoot. Why? Because look at that liquidity. Look at the amount of retail traders that would be selling here. Remember, price is always attracted to liquidity. So that is our target area that we're going to look to take our trade off. So we're going to take our trade here, and then we're going to take our trade off over here. So 415 pips. Risk to reward of 39.23, which we'd like to put to 50. So we double our account if we risked only 2% of our trade. That's the beauty of Elliott wave theory and institutional trading. Now, where is liquidity resting? Over here. Retail traders would sell on the double top. Retail traders would sell on the double top. But we know where price wants to go. We know we're not going to take our orders off here because we know there's liquidity resting here. We know price is eventually going to get there. Take out that liquidity before price pushes down. So we know where price is going to go. That agrees with Elliott wave theory and institutional trading. So once we take out this liquidity, after we encourage retail traders to sell, take out this liquidity, trigger out these unfilled orders, and then bang. Okay, that's why I'm bullish on the US dollar. So yeah, that's my analysis for the US dollar CAD, and it also fits with gold because we're quite bullish on US dollar, so gold should go down as well. We also actually have liquidity over here as well, equal lows. Ah, that's where it is. Okay, so at these equal lows at a retail support zone, that's what retail traders are doing. That's why this move up. That's why engineering. That's why liquidity was resting here, and it was engineered here before our bullish order block. So yeah, we'd go into our 1 minute time frame, look for confirmation, and then take that trade all the way up another 415 pips. And then we also have bullish divergence with the histogram divergence. Beautiful trade. So I hope this helps. Best of luck to you guys. And make sure to check out our website or sign up for our course or our free public channel if you're interested for daily analysis and updates. Good luck.
Hey everyone, hope you are all doing very well. Ahmed Memon here, owner of A&A Capital. The pair I'm going to be analysing is EJ, the European yen. So during this week, there will be a lot of manipulation, a lot of big SL hunts. That's why we have to be very careful before entering a trade. The American elections are now done, and of course, as everyone knows, Biden was elected 46th president of the US. Are people happy with this? Do investors trust the the dollar at the moment? There's a lot of speculation going on. Like, all these questions mean that the other safe haven, which is the yen, would be a lot of trust in, and there will be a lot of trust placed in this, which would cause the price to move down in the direction we want. A large pump of money would be pushed into the yen, which means the yen would gain strength. The euro is, on the other hand, is not considered a very safe currency to be putting money in at the moment. So all the speculation would possibly mean that the euro yen is coming down, and as we can see as institutional traders, that there is a lot of potential for this to come down as well. It's all politics at the moment. As politics play out, we will know what will happen more to this trade and how it will be placed out. Let's go to the weekly for an overview. So as you can see at the candle before the elections, there was a really large bearish candle. So this is obviously due to, as I was speaking that breakdown last week, that pressure was pushed down into the yen, which is considered a safe haven. As retail traders would have thought that this price would be continuing to going back down due to becoming considered a safe haven. We knew as institutional traders that there was unfilled orders in this weekly candle, and that's why price has pushed straight back up to the top of this candle. Price will be coming up. It broke through this retail trend line very impulsively. There was not much to draw down. I was watching it last night, and it just broke through really nicely, which shows us that there is a lot of momentum being made. That these equal lows were broken really nicely as well. Like, as you can see, that it tried to break it last week during the elections, but it wasn't possible very nicely. But here, this current week so far, it just broke up really nicely. Price is approaching the entry, so if you want to look for live entries and stuff like that, join our Telegram channel. The link will be in the bio, so it will help you look for nicer entries and where to place entries. The group is completely free, no charge whatsoever, so if you're looking to join, definitely join and get in touch with one of the analysts, and we'll set you up if you want to become a full-time trader. So as I was saying, the Fibonacci was also taken from here to the equal lows. As you can see, price broke through the 38.2% really impulsively. This is usually what I consider a deep hunt on the weekly, but as you can see, Biden was elected. The elections had a big effect on the market, and 50% is also now hit. So that's where our entry is looking at the moment. So hopefully price comes back to our entry and then shoots back down. Let's move on to daily for a quick review. So yeah, as you can see, during last week there wasn't many proper closers. Like, if you're looking at this as an institutional trader, there's a lot of pressure being made on Wednesday and Thursday. These are the days after these are the days leading up to the election, and then Friday was a much slower day, and that's when the election results were announced. This shows us that the institutions are not ready to take these orders straight back down. And as we saw on Monday, price was pushed back up. It has broken through these equal lows very, very impulsively, which shows us that an SL hunt is going wrong. And this retail trend line again, it's breaking through very, very nicely. It's adding a lot of confidence into a big SL hunt by an institution before price is being going to be brought back down. Let's just look at the 4-hour chart really quickly. As you all know, that a head and shoulders is a reversal pattern, and it was trying to form one here with the left shoulder, the head, but the right shoulder was never properly made, and that is a very good sign for us as well, as the institutions are now recognizing these type of patterns and are not letting them being built. As institutions know, we know that if it's not clear, if it's not clear here when it's trying to break these equal lows earlier, there will be a retest, and that adds us a lot of confidence into bringing price back.
Hi everyone, and good morning. Today is Sunday, November 8th, 2020. And today I'm going to talk about what occurred last week with the dollar index. So, what we saw with the dollar index that took place this week that just passed, this week we saw a bearish engulfing that was formed on the weekly chart on the dollar index. We saw a bearish engulfing that was created that engulfed this bullish candle. What does that mean? That means that we expect to see the dollar to keep on falling and to continue losing value, especially now that the election is done, and along with now that we have a new president in place. So yeah. So now that we know what's going on, now that we know that the election is over, and we know who's the new president, who's going to be the president, I expect the dollar to keep on falling, including with this engulfing pattern right here that took place. Now I want to keep in mind though, despite that, now that the election is over and that we now know who's going to be president, it does not mean that the uncertainties that can take place within months going into 2021 is not going to happen. There's still more uncertainties that's going to take place that we must be very cautious about, that we have to be aware and be prepared to tackle as we go into these markets the next couple of days and couple of weeks and months, etc. So yeah, now that we see a bearish engulfing that took place, I'm expecting the dollar to fall around this location, this weekly demand zone right here, where the impulse moves to the upside was created by banks and institutions. I'm gonna show you guys right now what I'm expecting the dollar to do. It dropped right, it fell, it closed right below this candle right here. So what I'm expecting to do is that the next upcoming days, I'm expecting it to rise a little to the upside and then to continue falling all the way to at least around 90.30, where the location of the south side on the weekly, which is the man zone, is created, and then to rise to the upside. That's what I'm expecting. That's what I'm expecting to see on the weekly chart. For price to fall, for price to start falling and losing value, especially now that there's a new president in place, and according and the policies that he may have that can alter the dollar. Let's go to the daily. And also another evidence that I have that we can see the dollar start dropping is that we see a form of downtrend that was just created right here. This high right here, this pivot high right here is lower than this pivot high right here. and then price break going down, breaking this area of support, making this new low a lot lower than this pivot low that was formed back in October 21st. I'll show you guys right now with this trend line right here. So yeah, so what I'm expecting right now is what I'm expecting here on the daily, which I'm gonna show you guys in more detail. I'm expecting price to continue falling, respect this small area of support on the smaller time frame, shoot back up a little bit around here where on the pivot low was broken at, and then start falling. So I'm expecting this type of movement to happen on the daily chart. Because all this move right here that took place, I'm gonna show you guys right now. All this movement right here that took place, especially this one right here, is because of uncertainties with where the election was going between Donald Trump and Biden. Especially this one right here on the 4th of November. This was after election day. Uncertainties, like this was uncertainties. Like, one, price created a gap to the upside because numbers were coming in stating that Trump was in the league and stuff in the beginning, and then all of a sudden, when Biden was taking the lead, beating Trump, that's where the change in price drastically took place. Price was going up at first, and then it created this topping tail because the outcome of the election was changing. So that's why this topping tail was formed post-election, and then price just started continuing to fall afterwards. So I'm expecting throughout the week to see the dollar index to continue falling all the way to the downside, to where unfilled orders on the daily, at least around here, is located, where banks and institutions left unfilled orders for price to turn back around, and either around this location right here, or at the beginning, or at the beginning of the move down here, where price can start turning back around to the upside. So yeah, so my advice is on trading with the dollar for these next couple of weeks and couple of months coming in 2021. Just still keep an eye on the dollar index, where it's going, and also make sure you keep an eye on upcoming news that the dollar could have, and make sure you still be very cautious and have proper risk management and good risk reward ratios when trading with the dollar, and make sure you're ready for uncertainties that could take place. With that being said, I'm looking forward to this brand new week and getting ready to tackle this market, and then from there we just have to see what